come back to these if we have any time. Again, sorry, I blanked a couple of these out so I don't have to bore you with disclaimers. Candlestick charts are very much like bar charts. It's exactly the same information. High, low, and a little tick off to the left is the open, and a little tick off to the right is the close. What candlesticks do is emphasize the intraday portion of the channel, of the trading, by making a box that starts with the little left-hand tick for the open and goes to the little right-hand tick for the close and filling it in. That highlights what happened during the day. So for this stock, we know it opened here, probably rallied, almost back up to the resistance of the previous day's low, but then falls to the low for the day before rallying just a little bit off that level. The idea is that from the open to the close was pretty negative. You know, there's a lot of day traders out there, a lot of floor traders that are pushing the stock one way or the other, but at the end of the day, they go home flat. So by the end of the day, you're looking at what I would consider more the true direction for the day, and that's what the candlestick really emphasizes. Then you get another day like this one, where the open and close are very close together. And the idea there is that supply and demand are more closely in balance. So these are really negative days. These are days when the buyers and sellers were pretty much flat for the course of the day. And that tells you something about the strength of the downtrend. I borrowed these a couple of these charts from Steve Nissen at candlecharts.com. He's, of course, the guy really who brought and introduced candlesticks here in the States back in 1990, I think, and does a great job out there, has a free educational newsletter. So if you are interested in finding out more, that's a good start. Basically, here's the open, here's the close. Remember, you got to take this back. As Barry mentioned before, the Japanese were doing this for hundreds of years. So you're doing it on paper. So you've got fill in the box in the case of a down day, or just leave the box blank. So the traditional colorations are, if it's an up day, meaning that the open is lower than the close, so between the time the stock opens and the time it closes, the price went up. If it's an up trading day, you leave it blank or color it white. And if it's down, the open's up here and it drops from there to the close, you fill it in black. Now, on almost every piece of trading software now, you can color it however you want. And I see a lot of people with green and red. Green for the up days and red for the down days. I use red for the down days because I think it stands out to me just a little bit more than the black. But again, like whether you use X's and O's, it doesn't matter what color you color these things as long as you understand which way you colored them. If the day is an up day during the day, you want that to be a different color from the down day. And the idea is that you're seeing from the intraday pattern of trading whether the overall move is, you get some clues about whether the overall, the larger move, is likely to continue. Now here are a couple of examples. Day one opens at 23, trades up to 26, and as low as 21, and closes at 25. So here's this day. It opens at 23, closes at 25. You make the box and leave it blank or fill it in with white. The next day, you have a much narrower range between the open and close, even though the daily range is about the same. Day after that, you open down here, had one heck of an intraday rally, right? We know that this rally comes after the open. Nothing's before the open. So it opens here. You have a heck of an intraday rally, but then you close at the low for the day. Again, giving you some idea of beyond just the day's information, but giving you a little better idea of the pattern of trading that took place during the day. The real body is the name of this square. All right, this is it's Japanese, so there are all kinds of very colorful price patterns that you can get into. Dojis, hammers, 3 black crows. You know, there's lots of colorful names for the patterns. But the idea is it tells you who's in control. The buyers are in control. It doesn't really matter. During this trading day, the buyers are in control. The previous day, this stock could have been 10 points higher. But from the open, you would rather have been a buyer than a seller. All right, the stock could still be, let's say this is 22 and this is 23. The stock closed yesterday at 32. You still would rather have sold it yesterday. But in terms of what can you do with this stock during the day today, this was a good day. Even though, in this example, it gaps down to here, and yet the sellers are not able to push it any further than that, and it starts to rise. So that's telling you during the day who drove the stock, the buyers or the sellers. The small real bodies are telling you that supply and demand are more closely in balance. So there's, and again, as this chart says, you may gap down, all right? This day closes here and opens here. So it's down on the day, but during the day, supply and demand were pretty closely in balance. A little difference there, but not a whole lot. And during the day, prices actually were up. From the open to the close, prices were up. So this is, we'll see that this can give you a clue about where you go. This is a doji, is when the open and close are the same. So this is an extreme narrow real body. These are often, these dojis are often reversal patterns. So for example, let's say you find yourself in this uptrend. Okay? I know I'm here or I'm here. I know the stock is in an uptrend. It has been going up. And you hit a day with a very narrow real body. It's a warning sign. Is it a guarantee that the price is going to change direction? No. But this is not what you want to see in an uptrend. In an uptrend, you want the stock to move higher during the day. So the fact that between the open and the close, now this is an up day. You'll see the close is here, the close is here. So it's up on the day. But during the day, there was really very little price movement. That turns out to be a small reversal point. You're coming down. You have these big black candles that show you the bears are clearly in control, and then a spinning top down at the bottom, another very narrow trading range. You start moving up, these big white candles, and there's a doji. Okay, open and close the same. These are just warning signs. You want to use them in conjunction with the other stuff that you're using, but you're looking for the action during the day to give you an idea of whether the buyers or sellers are more dominant. And as you can see, that the top of that doji becomes a resistance area. You test it several other times, and then you have a big breakdown. So you get more information from the same data that bar charts use by looking at a candle chart. You use them in concert with your other technicals. So use them with moving averages, with other support and resistance areas, old highs, old lows. I don't think you use them for intraday charting, because the whole point here is that by emphasizing the open and the close, we're assigning them a higher significance. And I think on a daily chart, they deserve that higher significance. The opening price is where everybody's had all night long to think about this stock. Any news that's come out since the market closed yesterday. And so the opening price is represents a lot of time and thought people have had. Similarly, the closing price is the end of the day. All the day traders are out, and that's what really, that's a really significant price as well. In an intraday chart, let's say you're using a 5-minute bar chart. What's the significance of, market opens at 9:30, 9:30 to 9:35 is your first bar. 9:36 is the first tick in the next 5-minute bar chart. I don't think there's any significance for moving from 9:35 to 9:36 or 10:04 to 10:05, you know. So that's where I would use bar charts on intraday charts. Maybe even on weekly charts. I think, again, the sort of weekly opening, the weekly opening would be important, but not as extra important as the daily opening. So I would use candles primarily for daily charts, also for weekly.